Building a cloud startup from 1 to 100 million requires a clear vision, exceptional product innovation, and of course, go-to-market strategies that drive a business towards market leadership, and a great team to make it all happen. But what are the milestones from a metrics perspective that let you know that you're on the right path? At Bessemer, and especially on the growth team, we know the universal questions every founder, CEO, and CFO asks as it relates to financial and operating performance. What does a typical cloud company look like at a particular phase of growth? And what determines best in class? For Bessemer portfolio companies, we have historically supplied those answers, leveraging anecdotes from our experience scaling successful cloud companies such as Twilio, Shopify, Procore, PagerDuty, Toast, and many more. But not every startup has access to that history. That's why we decided to open source the metrics from our cloud company portfolio to contribute to not just Bessemer's cloud company growth, but all cloud companies. To that end, we spent the past year aggregating thousands of data points from over a decade's worth of cloud investments in hundreds of companies. And we invite you to read our full report, Scaling to 100 Million, on bvp.com/scale. But for now, I wanted to focus on 5 key takeaways every cloud founder should know as they look towards that 100 million milestone. Let's dive in. Takeaway number 1, every cloud company should have the same North Star, and that's ARR, or CARR, and its growth rate. ARR growth rate is a key signal as to whether or not an individual company has the product, sales efficiency, and market leadership to become a leading company. Across hundreds of private cloud companies' data, we find that the average growth rate for businesses between 1 and 10 million of ARR is 200%. In other words, the average cloud company triples at that scale. While private cloud companies should expect growth endurance of 70% every year, and therefore a typical deceleration of growth rate of 30%, an important takeaway for cloud founders is that even at maturity, at 100 million or more of ARR, the average cloud company is still growing quickly, at 60% year over year. The top quartile is growing even faster at 80%. As you scale from 1 million, you'll want to maintain that high growth endurance to reach the growth velocity to power you to 100 million and beyond. Scale wins in cloud economics. The larger you are and the more revenue you have, the more defensible your business. Market leaders create a virtuous cycle with pricing power, talent, and product that reinforce their lead and help to perpetuate their growth. Net new customer additions obviously contribute to ARR growth. But just as important to the health of a cloud business is the retention and expansion of existing customers. So that brings us to takeaway number 2. Net retention rate is a key component of ARR growth. Across the past decade of Bessemer cloud investments, the average net retention for companies between 1 and 10 million of ARR was 140%, decreasing to an average of 120% for companies at 10 million or more. This suggests that to be a successful cloud company, you generally need a model in which your customers increase spend with you by 20% per year. When we look at the top quartile of cloud companies at 100 million and beyond, net retention is even higher at 125%. For cloud companies, it's powerful to think about net retention in the context of target ARR growth rates. Getting to that average 60% growth rate for companies above 50 million of ARR is a lot easier when 20% of growth or more is already contributed by your existing customers. Now, your sales team only needs to find the additional 40%. This also brings us to gross retention, which averages above 85% across the lifetime of a cloud business. When cloud businesses retain existing customers, they don't need to use valuable sales and marketing dollars to refill a leaky bucket, but rather, they can use that expense to generate net new revenue and more net growth. Retention is one of the most important measures of cloud business health as it preserves the unit economics of historical customer acquisition. Getting paying customers and catalyzing revenue growth is the goal, but as a cloud company, you want that revenue to be as profitable as possible. This brings us to takeaway number 3, make your gross margins as high as possible. Gross margin measures how effective a company is in delivering its software to its customers, and it captures variable costs, generally inclusive of things like customer success and cloud hosting costs. Regardless of maturity, the average gross margin for a cloud company is about 65 to 70%, and the distribution of the middle 50% stays within about 60 to 80%. This is a small window. Cloud companies don't have much wiggle room with gross margins if they want to be successful. That's largely because the higher the gross margin, the more money a cloud company can invest into operating expenses rather than into product delivery. This leads to more selling, more product iteration, and therefore more growth. Most of those freed dollars, as we'll explore, will go into sales and marketing. Which brings us to takeaway number 4. Sales efficiency is capital efficiency. From 1 to 10 million of ARR, the average Bessemer cloud company spent 95% of revenue on sales and marketing, and this only decreased to 50% of revenue by 100 million of ARR or more. Given how high cloud business models require sales and marketing spend to be across their lifetimes, you should use the CAC payback metric as the measure of the efficiency of that spend. CAC payback is the rate at which the cost spent to acquire a customer is repaid by that customer. And we find that between 1 and 10 million of ARR, it's 15 months, increasing to 30 months at 100 million or more as the marginal customer becomes more expensive to acquire. We want to ensure that the millions we are spending on customer acquisition, it's justified with strong unit economics. S&M spend also tends to be very high throughout time because it scales more linearly with revenue growth than do other operating expenses. Research and development expense, which captures product and engineering, tends to be high initially at 95% of revenue from 1 to 10 million of ARR, as product innovation is a company's opportunity. Ironically though, the average cloud company only spends 35% of revenue on R&D by 100 million of ARR. Similarly, general and administrative expense, which also covers back office functions like finance and HR, in addition to company leadership, tends to be high initially at 70% of revenue and decreases to 20% by 100 million. Cloud companies should strive for leverage in both of those line items, allowing them to feel comfortable spending on sales and marketing while working towards profitability. Putting all of these pieces together, from revenue generation to cost and expense centers, we get to what really matters: how much money a company is generating. It's free cash flow. Introducing takeaway number 5. We want to balance growth with profitability. The average Bessemer cloud company had a negative 230% free cash flow margin between 1 and 10 million of ARR, which decreased to negative 35% by the time it was at 100 million of ARR. Because, as we just discussed in the last section, it gets leverage from its operating expenses and revenue grows. The goal of any company, cloud or otherwise, is to generate cash, with the average BVP NASDAQ emerging cloud index company generating about 10% free cash flow margins. But remember, not all burn is bad. For example, while burning 100 million a year sounds high, if a business added 1 billion of net new ARR, we'd probably consider that a win. As this hypothetical suggests, investors look at the cash consumption of a business relative to the revenue that it generates, which is captured in the efficiency score metric. Efficiency score equals free cash flow margin of ARR plus year-over-year ARR growth rate. This metric helps to show the trade-offs between growth and profitability, but it generally only applies to companies after they achieve 25 million of ARR. Best-in-class efficiency scores tend to exceed 50%, whether driven by growth or profitability. And we find that newer companies often have higher growth rates and higher burn rates. However, companies at maturity tend to have lower growth rates and lower burn, working towards cash flow profitability. Now, we've only begun to scratch the surface in terms of the metrics and benchmarks leaders need to know as they scale to 100 million and beyond. But we hope this was a valuable preview for you. In our full report, you can dig into the detailed data sets and dive into other important insights on growth endurance and cash conversion score, and even find out the benchmarks for valuation multiples and dilution across time. Let us know what you think of our Scaling to 100 Million report, found at bvp.com/scale, by sharing your thoughts with us on Twitter. Until then, we hope our research can play a small role in your team's success as you build tomorrow's next great cloud business.